Hi, welcome to the March version of Transaction Review and Calculator Practice. As always, I just want to remind you that you can chat any questions to me using the chat box, and try to get to them. Does anyone have any burning questions right off? Anything that they're really struggling with or wanting to talk about? I'll wait a couple seconds. Okay, well, just feel free to pipe in, and I can unmute people and see how that goes. But anyway, here we are at, gosh, I can't believe it's March 7th already. I chose a couple of deals to go over that have been put on my plate this week. You know, when you're in the note business, or at least this is my experience, and probably many of you have similar stories, but when you're doing buying notes or making loans, a lot of time you become sort of a problem solver for people, and they don't know what you can do and what you can't. So, like a lot of my time, I try to keep it a reasonable amount, but people email me, questions, and they not members of the community, just people who find me online, or they leave me a message and they're wondering, can I potentially help them or not? So I think if you're going to be in the business, that you need to just get good at fielding a lot of these questions and quickly knowing, what you can do and what you can't, so that you can either spend your time working something over, or you can just say, sorry, I can't help you next, or, okay, this is a question from Eric. Hi, Eric. He says, I've been trying to figure this out for some time. The manual states enter negative values for outflows, cash paid out, and positive values for inflows, cash received. With that said, what determines cash paid out and cash received? Maybe you can use this problem. What is the, okay, I'm going to pull this up right now. Where is it? Okay, I'll pull it up right now. Okay, Eric. So he says, and I'm going to clear all. Eric, do you have a handheld or this app that you're working with? I mean, the handheld looks like this. But anyway, okay, so 10,000. Okay, the handheld. So let's put this down and just use the handheld, because does this look like what you have, I hope, if you have an HP 10B2. So clear all. So we have 10,000. That's the PV. And note amortized over 30 years. 360 there at 14.5%. Right there. And all due in 5 years. Okay, well, I don't know that part yet, right? But the future value, I don't know yet, but I got to get what the monthly payment is. So once I have 5 or 4 of these, I can solve for the 5th. But right now I'm going to put a 0 in future value, because I just want to see what a fully amortized 30-year payment looks like. So that looks like that can't be right. Can that be really right? 100,000, 10,000. I guess so. That's only 10,000. I was thinking you said 100,000. Okay, so that's a really low payment. Right now we need to find out what that balloon is, so we can put that number in here. So on the handheld, here's how you do it. And it's a little not very intuitive. And so here we go. So I'm going to enter the range of payments. So number 1, from the first payment, and I'm going to put input. Okay. Then the last payment, I want to know what the balance is at the end of, did you say 5 years? 60 payments. Okay. Now I'm going to hit the shift key and the amortization key. Okay, so now I have my period from 1 to 60 payments, and I use this equal sign to move through. Okay, the principal, 142, the interest paid during that time, 7,200. The balance, every time I click this, it goes again. See, I can just keep clicking through. So that balance is, I'm going to write this down for myself, 9857.83. So that's going to be the balance at the end of 5 years. So now I want to get out of that. So I click just double click on any number of these buttons up there to get back to the regular spot. Now I'm going to enter the balloon. 9,857.83. Now that's, I think you're coming in, so I'm going to put this as a negative number because I always do this for myself, and I'm going to explain in a minute, okay? Okay, also, if we recall payment, it's a negative number as well, right? So these two numbers, I always enter or see them as negative numbers because that's just how I remember to do it. I don't want to go, wait, am I making the loan or borrowing the money? Am I the lender or the borrower? So I just always keep it the same. But technically you could say if you made this loan, if you borrowed this money, that's a positive number because you got the money into your pocket. It added to your bottom line. But this number, your monthly payment, is $122 out of your pocket. Okay, so and then at the end of 5 years, this is a balloon payment that goes out of your pocket. Okay, so that's negative there. Obviously, the number of payments are going to be the same. Interest rates, hopefully you don't have a negative interest rate on your investments. If you're borrowing money, that would be great. Anyway, so does that help, Eric? Is that kind of what you're wondering? Like if I was making this loan, I could do it different, right? So if I want to say all the time when money's going out of my pocket, it's going to be a negative number, and every time it's coming into my pocket, it's going to be a positive number. You can choose to do different. For me, these are always positive numbers. These are always negative numbers. That's just how I remember it in my mind. But if you want to do it based on whether it's coming to you or going, so like I said, if you are borrowing $10,000 from someone, you're getting this positive amount into your pocket. Okay, you said it's helping some. Okay, and that's going out. Now, if you're going to lend $10,000 to someone under these same terms, let's make that $10,000 going. Let's make it negative, like it's going out of your pocket. So that's principal, present value, or loan amount, right? So then that's going out of your pocket, but that payer on the loan you just made is going to put money in your pocket, right? So let me go back to making these zero. Okay, so we know we've got 360 there. We know we've got 14.5% there. We know we just lent somebody. It went out of our pocket $10,000. Now I want to solve for payment. So I click payment. Look, it's a positive number because that money's coming in. Okay, and then of course we already figured what this is. But since the PV is negative, these things will be positive. Okay, so that's how it would look. I hope that helps a little bit. But it just takes a little bit of practice and you'll get great at it. So anyway, thank you for asking that question. I really like the interaction and knowing kind of what you guys are struggling with or what I can help with. So appreciate that, Eric. All right, so I'm going to go back to this one that's nice and fat. Okay, this lady called me and she has a property in Boston, Massachusetts, a condo that she and a partner bought. I guess she found the deal and I guess the other person could qualify for a loan. So they went in on it. They JV'd together on this thing. And the property value, and now the partner wants out. The person who called me is trying to find out if I can give her a loan to buy out her partner. Okay. And everyone thinks that either loans or discounted notes somehow can do some really magic. And sometimes they can, but they really can't get over basic market realities and things like that. But anyhow, so the existing bank loan is 113. Not bad. It's about 50% loan to value. Look at this. They have a fixed 4% 30-year amortization on this condo. I mean, that's such great financing. You cannot afford to get rid of this financing. That would be just a crying shame. So basically, the PITI, principal, interest, taxes, and insurance, is $900. The HOA fee every month, homeowners association fee, is $245. Okay, and it rents for $1,800. Okay, so basically they have the cash flow, and I'll just, since we have the calculator here, we'll just use it. So basically they get in $1,800 a month, and you'll see why knowing these numbers is important as we go along. Minus 900 for their PITI, minus 245 for HOA. That leaves a positive cash flow of $655, but this doesn't count for any maintenance, right? A plumber, a faucet, anything like that. So if everything goes perfectly, they get $655 a month. Okay, now she wants to keep this thing, but she can't, but her other partner wants out. So let's figure out, and I said, well, how much equity is there? Where'd my thing go? Okay, 225. And let's just figure out, for really figuring out fair equity, then let's figure out what the split would be if you sold the property for fair market value. And of course, if it's worth 225 and you actually get it, you're going to have, if you list with a realtor and with that and on your closing costs, it's fair to say that your closing costs will be 8%. So let's just figure that times 8%. Remember, percentage-wise, percents are the same as decimals, two places difference, right? $18,000. So, and then we know they have the existing bank loan. So if they sold this for $225 minus the $18,000 in closing costs minus the $113 that they owe the bank, they would have $94,000 to split. So divided by 2, each of them would get $47,000. And that's what the one gal is trying to get her to do. But I said, well, what will your partner take to walk away? She said, oh, she'd walk away for $30,000. That's reasonable. 30 divided by 47. She's willing to take 60, basically 2/3 of her equity and just say, yeah, you can keep it if you give me 64% of my theoretical. Maybe they'd listed at this and it wouldn't sell. Maybe it would sell at 210, or maybe it would not sell at all. Who knows? Maybe they'd have to drop it to 200. So this theoretical equity, so she goes, what? Surely I can get $30,000 to pay off this gal. So yeah, obviously, why don't you refinance for $143,000, the $113 plus $30,000, and but she can't qualify for a bank loan on her own. That's one of the reasons she has that partner in the first place. So that's not going to work. Well, she goes, surely you can just make me a private loan. Okay, so what's that do? Oh, you can make me a private loan. And I said, well, I remember how we said how precious this financing is? Why in the world would you pay private money rates when you got it locked in at 4%? I mean, that's the only reason this property is cash flowing. And mind you, this whole conversation takes place inside of maybe 7-8 minutes. So we're just speeding through, what could work and could not work. And so let's just see if I could. Here's why it won't work. If I gave her a private loan, if she needs 143, but I'm just going to say she needs 150 because she's going to have to pay closing costs and points that'll have to come out of this money. So let's figure out my loan to value. Either loan to value or investment to value is one of the first things I always look at. Okay, so the loan divided by the value of the property equals 0.67, which move the decimal 2 places to the right, and you have 67%. That's a little high for my taste, but it's in the realm of marketability, what's normal in the market. Okay, now even if I could get her a killer 10% interest rate, let's say we did it, here, let's see what her payment would be. Interest only, 150,000. She's not even reducing any principal, times 10%, which is move the decimal 2 places. So 0.10, okay, equals 15,000 in interest for the whole year. So if I divide by 12, I get how much she would owe me for, so she'd owe me $1,250 a month. Remember, 900 was covering PITI. Now, $1,250 only covers interest. Okay, so she thought that would be a good idea. And then I go, well, 1,800 minus 1,250 you owe me minus the HOA leaves you 305 to cover taxes and insurance, which I reverse engineered to be 360. So I get that she's going negative $55 a month. That doesn't sound like a very good investment to me. And here's how I reverse engineered that to figure out what taxes and insurance were. Okay, remember going back to the basics of the deal. Okay, the loan she has, the loan amount was 113. PV, right? Loan amount, present value. It's a fixed interest rate, 4%, goes right there. Term, 30-year fixed, so 30 years times 12 months in each year, 360. It's there 0 for future value. There's no balloon. This is going to be completely paid off. So let's just solve for payment. Great. So now I know that's the principal and interest payment, but I know she pays $900 a month. So all I have to do is take this number, which is there already, and I'll just add 900 to get the difference. And there's my, that's what this is going to be pretty close to right on, 360.52. Okay, I think that's what I got to here. Oops. Okay, so 360.52 taxes and insurance, that's how we figure, okay, so then that's not going to work. You guys feel free to ask any questions or make comments that I'll read to everybody else. And if I'm going too fast or too slow, let me know. I know some of you, this is a really review, and some might be having a hard time keeping up, but we'll just do the best we can here. Okay, then the next thing, well, what about I just lend her a second, right? We keep that, we leverage that wonderful first financing, and I just loan her a second. Okay, we have the property value there of $225. And so we just give her a $35,000 loan because she's trying to net 30 to pay off her partner, but here we got just padded up for closing cost points and things like that. So let's see, what's the combined loan to value? Yeah, I'm only making a small loan, but now I got to go, what's my combined loan to value? Yeah, that's all I'm doing, but I got to count on what's ahead of me in superior to my lien position. So now we're up at 148 combined loan to value, CLTV, and I'll divide it by 225. That gives me 66, almost the same. Makes sense, right? Almost the same as the last one. Still, you know, borderline, almost okay. It should kind of be okay, even though most people don't do a lot of seconds these days, but there's a market for it. Now let's say I actually wouldn't do this deal, but let's just say I would, and I felt okay about a 13% interest only. You know, just for kicks and giggles, like let's help her out, help to figure out what numbers are even feasible for her situation. So times 0.13, right? That's 13%. That's the interest for the year divided by 12 is 379.17. Okay, so then she'll owe me that. So let's see how her numbers work now. 1,800 minus 900 minus, you know, that's the PITI on the first. Here's the second. Here's the HOA, 245. Now she only has 275.83 passive income. Okay, so this still might be a good deal for her if I would do this. But here's the thing, I'm not licensed to do loans, just to make loans in other states besides California. And so I'm a little leery of doing that, although I know actually quite a few people who don't worry about that licensing issue, but it's something I think about. Like, I would have to hire somebody and an attorney and make sure I understand everything about Massachusetts. I've never bought a note in Massachusetts. I've never bought a property in Massachusetts. It's way out of my, backyardness of understanding. So, anyhow, so I'm really not keen on doing that, but you can see that could work for someone who lives in her neighborhood, might be really happy to do that. Someone who live, right down the street. Yeah, I'll make 13% on my money, secured by, with 30% equity on top of me, no problem. Okay. But for me, that just doesn't work. So then, my only, so after we do all of these like gyrations, all right, so then I just said, gosh, why don't you just sell? Because that's what she wants. And you can take your part, 94,000, and take your half, your 47,000. If you invest in a note, she's really hip on property. She really likes property. So I go, why don't you do a note and property combo? Invest that 47,000 in a note where that's your principal value. It'll be interest only. So that will also be the FV there. And then you can get 9%. And sometime in the next 5 years, the property will be sold. Okay, so did you get what we did there? 5 years, 9%, put in 47, you'll get out 47 as a balloon payment. In the meantime, you get 352 a month. And 352 is better than her, remember this number? 275.83 if she got a second. And then at the end, you get 50% of the collateral. So if the property sells, let's say it sells for, what's 47 plus, 24,000. Okay, so then the property sells for 71,000. Of course, I'm not counting for closing costs, but you get your $47,000 back when they sell the property. In the meantime, it's cash flowing for them while they're giving you your cash flow, and then divided by 2. So then you'll get 12,000 at the end. So this is a way for you to participate in owning rental property out of state without having to manage it, and knowing everybody's going to profit at this, on this, being on the same page. Managers will profit and the investors will profit. So if you get, so let's put that in as a balloon. What's 47 plus 12? What is, I should be able to do that in my head, but here we go. Okay, 59,000. So that's what your balloon would be instead. That was so easy. Anyway, okay, so now let's see what your yield's going to be. Now your yield jumped up to 12.68. Okay, so this is something that she could do and not have the headache of an over-encumbered property. And then also, after we figured out all the potential things we could do, she said, oh, I forgot to tell you, my partner refuses to leave her name on the loan. So there's no way she's going to let us leverage that existing financing. So I said, you should just sell. And yeah, if you can buy another property or do something like this, you're at least a 9 and most likely a 12% yield. So anyway, that was just my suggestions to her. Like I said, all within about 7 or 8 minutes that we were on the phone. And it's just kind of nice. Number one, you never know what might turn into a deal. And number two, it's nice to do a little, pro bono every now and then and see if you can, send someone on their way to give them a realistic picture. And we're kind of out of time. And are there more questions? I'm not seeing more questions. Oh, she will get less because, oh, thank you, Ken. Yeah, Ken was saying she'll get less because she has to pay Uncle Sam and take back depreciation, so the number will be a lot less. Thank you. I didn't even count in that. So, um, unless she's taking a loss, who knows what they bought it for, I guess. But anyhow, yeah, thanks, Ken. Sometimes I forget those tax things. It gets a little complicated. This is actually, and I think I can tell you this one real quick, and we won't go over too far, but this is actually someone I talked to just like an hour and a half ago. And this is a trustee of an estate who's having trouble with the other heir, which is her brother. Okay, so this is the overview. The trustee, this gal, and how I know her is back in the day when I was really brand new. This is probably when I'd quit my nursing job on a dime. You know, I did a lot of networking and pounding, going to groups and mixers and all sorts of stuff that I find a little bit hard to keep up with these days. But I went to an attorney group. It was a probate referee or a fiduciary type meeting, and I met a lot of attorneys and did networking. So this gal actually is an attorney. She and I had lunch a couple times, and she's very nice. And I think I helped her with one of her clients back in the day, even though I'm much more helpful now than I was back then. But anyhow, she remembered me, and I haven't talked to her in probably 5 years. Uh, anyhow, and so she's the trustee. The estate is the only thing it has left is this house, her mom's house, and her mom died a year ago. She has the full authority to sell her mother's house or to get a loan against it. She's the fiduciary for her brother that lives there. He's kind of unstable. He's letting the house waste, meaning he's not really keeping it up. And sometimes he just sort of disappears. And apparently they have don't have great communication. But he's living in that house. Okay. And right now, she's had a lot of health problems in the last couple of years, so she's not making hardly any money right now. And her brother is not making any money, and she can't afford, obviously, to subsidize his living over there. And they both need cash, okay? And their neighbor has offered him 65,000. The one he owns a house and a rental right on the same street, and he wants to buy that property. And I go, that's what you should do. That's a great deal. You know, this is a little podunk place out in Arizona somewhere. Okay, so she said, yeah, but I don't know what to do with my brother. I can't just kick him out into the street. I need time to build a relationship with him so we can talk and make some decisions and planning about where he's going to go. And anyway, I'll be getting a job soon, and I'll start having some income, starting this year to pay down the loan and all that kind of thing. So she really just, even though she could sell, it would be really traumatic emotionally for her to consider doing such a thing. And she thinks within the next 3 to 5 years that things will be in a different situation. So she wants just temporary cash, temporary someone to kind of walk with her down the path. It's more than just she needs money. She kind of just wants someone to look at it and think with her and help her evaluate her options. I mean, like one of the things I said, and type in any other things that come to your mind, but I said just sell the house, buy him a little mobile home outright on a piece of little land where there's no, there's no rent space or anything. I thought that sounded like a good idea, but maybe that's something but you just can't emotionally think of going there right now. So could I make a loan? I just don't like making loans. Sometimes loans in Southern California are just fine to do. And, making a couple points or something like that is fine. But on little loans, and especially out of state, it's just, it's usually not worth the risk to me. And like I said, the licensing issues could potentially come back to be an issue unless I wanted to pay somebody, and that kind of ruins the financial aspects. So I asked her what's the minimum. She said it's worth 65 based on what she's talked to the neighbors plus the one offer she has, written offer. But she says I really only need 30, so let's call it 35 because she's gonna have to pay some closing costs, right, and points and things. Even if I charge 5 points, which is more than I usually do on just regular loans, but on small things, it's hard to make it worth your time. And Ken, I know you do some lending. Do you have a minimum loan amount? Um, That'd be interesting to know what's the smallest loan you consider worth your time. But if I charge her 12%, which is a very fair rate, then the monthly payment would be 350. And right now they have taxes and insurance of 100 a month. So basically 350 and 100, 450 a month is what it would cost them. Let's see how far 30,000 would go. Let's say if I make the loan for 35 and they walk away with 30, how long will that last? 30 divided by 450, even if they didn't spend any of the money on anything else and just put it aside, which I know they're going to spend some, it would last them 66 months. So what is that? 5.5 years? Neither of them show any income, is what I said. Ken said, you don't have a minimum, but so you'd consider doing this, possibly? Tell me the terms you would do this as a loan, just out of curiosity. Taking him time to type. Anyway, so I said, but that's a lot of risk because what do I know about this guy? He's not taking care of the property. He's, it's wasting. So I want to be on the low side of things and lessen my risk. Here's what Ken said. Oh, he'd have to, okay, that's fair enough. You have to think about it. All right. And I don't want to be having exposure to foreclosure. I want to be able to, if something goes wrong, take possession of the property and sell it, whatever I need to do to make things right. So here's where I come back to my sales leaseback with option idea, because and even though there's going to be some liability for me being an owner, I can structure something that makes me feel that reimburses me for what I feel the risks are and the value that I'm bringing to the table, because I'll probably end up doing a lot of consulting in general of just being her friend and helper and figuring through some of these issues. But also I have less risk sooner to take control in the worst case scenario. But I still want something to work for them. So basically, if I'm going to buy it, the most I'm going to buy a property at for a sales leaseback with option is 65%. In this case, I want to stay way less. So let's call it $35,000. So what's that? 35,000 divided by 65,000. That's about half, 54%. So 50% of the value of the property, and the value is in my mind dropping. Let's see. Now, and what I would do is get 100% financing. I'd go to one of my investors and say, hey, if you put up the money, I'll pay you 12% on this. And normally a lot of my investors are actually in the 8, 9, and once in a while 10%. But for this, I think it's totally fair for a 12% return given this whole deal. So I would say, if you lend me 100% of the purchase on this, 12%, I'll pay you $350 a month, a balloon payment in 3 years. And what I'll do is say, as an option fee, I'll take $5,000 and I'll set that aside. A lot, most of that will just go on the bank for anything that comes up with this property. Some of it, I'll take a little chunk to put groceries on the table. Probably closing costs will be about $2,000 or so. Anyways, I'll charge them maybe $600 in rent. I think that's about right for market rent in that area. So the $350, that'll cover the loan that I owe to my investor. $100 for the taxes and insurance. And so basically, if they pay that $600, the difference is I'll have passive income of $150 a month. That's kind of what I would call a property management fee. and I wouldn't make it out too far. We know that if they, we saw that even if they spend none of the money, it's going to be gone in 5.5 years. And I know they're going to spend some money, so I might even make this 24 months, but let's say I make it 3 years, and then I'll make the strike price 38,000 on this, just so that I have some upside on the end. And also I know I'm probably going to have to be involved in signing papers, listing properties, signing contracts, all this thing. So that reimburses me for the work I know I'll have to do on the back end to get out of it as the owner. So that's probably something like that. And so at any time though, she can extra, if this doesn't work out, they run out of money or something like that, we can go sell to the neighbor. She can exercise her option, and she's still, she had a chance at putting things together, at getting herself emotionally stable, and then she could still sell to the neighbor, and I got the 5,000 if I didn't have to, spend any money for legal fees, repairs, or anything like that. 38,000, 150 a month passive. So if nothing goes wrong, which this is a little, there could be some drama here. So I don't know. This might not be smart. I'll have to sleep on this. But Ken says, first question to ask is, when they inherited the property, did the basis change to current value? And if that means no taxable event for them and they need all the money they can get. So you're kind of saying, Ken, that I should have them talk to their CPA, because you're saying that if they sell it to me now, it's better. Well, then I'll have the taxable event. I have to think about this from a tax perspective. Because if no, because I'll still sell it back to him for about the same price I sold it to him. So I'll be okay with the capital gains. But I'm not sure if I understand what you mean. If it means no taxable benefit and they need all the money they can get. Yeah, though she just died last year. So I think I'm not. I didn't actually ask her the basis, but that's a good point. I think I'll make sure she runs it by her CPA before she does this deal. So thanks for bringing that up. Good, good on the tax stuff. So anyway, we're overtime a little bit. I hope this helped. I really appreciate the interaction, and you guys have a good one. Hope to see you soon. Take care now. Bye bye.